How can you assess the financial strength of a condo building in New York City? We'll discuss this topic in the following video. I'm Nick at Hauseit, based here in New York City. Check out our website, hauseit.com, to learn how to save money if you're buying or selling real estate here in the Big Apple. So let's get started. Before you sign a contract to purchase a condo, it's important to assess the financial strength of the building you're buying into. If a condo building does not have strong financials, this puts you at risk of common charge increases as well as possible assessments. Before going into the weeds, we want to make it very clear that there is nothing inherently wrong with a building raising its common charges or levying an assessment from time to time. The cost of living, and by extension, the cost of operating a condo building in New York City, always goes up over time. In fact, annual increases of 3 to 5% are completely normal and nothing to worry about. Moreover, there is no getting around the fact that even the best-run condo buildings will need to make costly repairs over time to things like the roof, elevator, boiler, and facade. So if you're about to buy a condo and you discover that there's an assessment, that in and of itself is not a red flag. What is a red flag, however, is if the building never stops levying assessments, or if common charges are consistently going up more than 3 to 5% per year. So how can you assess the financial strength of a condo building in New York City? Well, the first thing to do is obtain the building financials. You and your attorney will typically receive a copy of the financials after there's an accepted offer. Reviewing them is part of the due diligence process, which your attorney handles in parallel with the negotiation of the contract itself. This is all done before you sign the actual purchase contract. However, it's also possible to obtain building financials before you submit an offer. Most sellers and most listing agents will have them available, so you can either ask the listing agent directly, or if you have a buyer's agent, ask her or him to obtain them. The first thing you should check is the accountant's opinion letter. This is always at the very beginning of the financial statements. You'll want to look for keywords such as presents fairly. This is a good sign of a healthy set of financials. Now, you won't want to see restrictive language such as subject to or except for. Such reservations warrant greater scrutiny by you and your lawyer and will often lead to other issues being unearthed. Here is an example of what we'd consider to be positive language in the opinion letter. In our opinion, the financial statements referred to above present fairly, in all material respects, the financial position of the condominium as of December 31st, 2019 and 2018, and the results of its operations and its cash flows for the years then ended in conformity with accounting principles generally accepted in the United States of America. The second thing I like to check in the condo financial statement is the size of the reserve fund. Essentially, how much cash does the building have on hand? A standard rule of thumb when evaluating a building's cash and cash equivalents is to make sure that it has a reserve worth around 3 to 6 months of the building's normal operating expenses, in addition to any anticipated capital improvements for the next 12 months. Now, if there's not enough cash, but there's a plan to deal with any anticipated capital improvements, such as a planned special assessment, then that works as well. Aside from the amount of cash on hand, it's also a good idea to check the accounts receivable and accounts payable line items in the balance sheet. It's never a good idea if accounts receivable are too high, as this may suggest that commercial tenants or unit owners are in arrears on their payments. As a general rule of thumb, you should do further due diligence if the accounts payable balance is greater than 10% of the annual building revenue. A normal co-op or condo building should not have a high accounts payable balance either. Bills in a normal building are paid promptly when received. There really shouldn't be debt accumulating, and an excessive amount of accounts payable owed to vendors may actually indicate that the building is undergoing financial trouble. The next thing to look at is the building's income statement. Now, it's important to realize that unlike a for-profit business corporation, a building's aim is not to make a profit. A building would like, ideally, to raise just enough revenue through common charges or other fees to cover its expenses and build an adequate reserve. So if the building covers all of its expenses but only shows a small profit, there's nothing wrong with this situation. However, if the building continually does not raise enough revenue to cover expenses, this is an indication that a common charge increase, or perhaps an assessment, may be on the horizon. Another question to ask when looking at the income statement is, what constitutes a building's income? Is there income from a tenant? You'll want to be very careful in analyzing the sources of a building's income and decide whether or not it's recurring. In fact, any source of income greater than 10% of building revenue should be investigated to ensure that it will actually continue. Finally, we also want to check the notes to the financial statement for additional insights. The notes may tell us more information about litigation, a recent special assessment, or perhaps changes in management fees. So there you have it. We hope you enjoyed this video, and if you did, please like, subscribe, and leave us a comment. We'd greatly appreciate it. And if you're looking to buy or sell, check out Hauseit.com to learn how to save money. I'm Hauseit, and we'll see you on the next video.